Hi everyone, welcome to this financial reporting topic explainer video on accounting for goodwill. Goodwill is a very important part of the syllabus and there is hardly any exam in which it is not tested. It comes up in the section A in a 2-mark question also, in which the examiner gives you the data and you have to calculate the goodwill. It can come up in the section B of the exam as a part of an objective test case question, and it can come up in the section C of your exam also. If we are talking about a question which is on consolidation, then it is going to be one of the adjustments, and it can also come in the interpretation part of the question, where we are dealing with an individual company versus consolidated statement or two consolidated financial statements. Nevertheless, goodwill is something that is highly expected that it is going to be there in the exam, because if you're talking about a long form question, definitely one company is going to acquire, other goodwill is going to be there, and normally it comes up in the section A and section B of the exam, when in the section C it is tested in the interpretation question. I cannot emphasize enough on the importance of this particular working. We are going to discuss it in detail, that what are the different components of goodwill and how can they be tested in your exam. So without any further ado, let's move to the topic and start discussing how accounting of goodwill is done in our financial statements. Let's start with the overall format of goodwill calculation. The goodwill calculation consists of different steps. I'm going to share the overall format and then I'm going to discuss each step in detail. Now, in case of goodwill, we start off with the fair value of consideration. This is the consideration which has been paid by the parent company. Then we have the non-controlling interest. Non-controlling interest can be at the fair value or it can be calculated as a proportionate share of the net assets of the subsidiary company. We'll discuss this point later on. From this, we subtract the fair value of identifiable net assets of acquiree. If you see, let's suppose parent company has 80% shareholding in subsidiary company. The fair value of the consideration is going to be for the 80%. Holding, the non-controlling interest portion is going to be the value of the 20% portion. Out of that, we subtract 100% of the fair value of identifiable net assets. So fair value of consideration and NCI combined is 100% worth of the company. We subtract from it the fair value of identifiable net assets of acquiree, 100%, and the balance that we get is called goodwill if it's a positive balance. If it's a negative balance, then we call it bargain purchase gain. Let's first of all start with the consideration, which is also called the cost of investment of parent company in the subsidiary company. There are different ways in which consideration can be paid by the parent company to the shareholders of the subsidiary company. The first form is the cash. So parent company can pay cash to the shareholders of the subsidiary company. The second form of consideration can be shares. Remember, these are going to be the shares of the investor, which is the parent company. And the third part is loan stock, where the parent company gives its own loan stock to the shareholders of the subsidiary company. Now, in this case, we can see further that when the transfer is taking place, if the transfer is taking place at the date of acquisition, then we recognize it differently, because at that point we don't need to calculate any present values. However, if the cash is being paid after a certain period of time, we call it a deferred consideration. Now, the accounting is going to change whether the parent company is paying the cash today, or which is the date of acquisition, or it is going to pay this cash at a date which is there in future, maybe 2 years later or 3 years later. And the third type is called contingent consideration. This is also a consideration which is going to be paid in the future. But the difference between deferred consideration and contingent consideration is that deferred consideration is something which is committed, which is confirmed. Whereas contingent consideration is something which is based on a condition. Let's suppose if the subsidiary company will meet a profit target or a share price target, then this amount will be paid. So it is contingent upon a condition which needs to be fulfilled, and this payment is going to be made in the future. Now let's see what is going to be the accounting treatment. If the cash has been paid at the date of acquisition, then we straightforward take the amount that has been paid and that becomes the cost of investment. If the payment is being made in future, so we have committed to give cash, but we've committed it after 2 years. So a half part, let's suppose we have paid right now at the date of acquisition. The parent company has given half of the amount to the shareholders of the subsidiary company, but the remaining amount is going to be paid after 2 years. In that case, we need to recognize this consideration at the date of acquisition, and it is going to be done at the present value of the future cash flows which have been committed. Remember, goodwill calculation is only done at the date of acquisition. Subsequently, there can be an impairment impact, but goodwill is not recalculated. It is calculated only once when parent establishes the control over subsidiary company. So this whole working that we are doing and the format that we just saw with respect to goodwill, it is all regarding the date of acquisition. This working is also done at the date of acquisition. So we calculate the deferred consideration, which is at the present value, and later on we have to do the unwinding of this present value, in which we need to charge the interest expense on unwinding to the statement of profit or loss, and the liability also increases. Ultimately, the aim is that after unwinding, at the time that we have committed, the deferred consideration is going to come back to the amount which was committed from the present value. If the company is giving shares to the subsidiary company, this is called share for share exchange. So the parent company is giving its shares in return for the acquiring the subsidiary company's shares. Now, in this case, the calculation is always done at fair value, which is the market price of the shares at the date of acquisition. Very importantly, keep in mind this working that we are doing is from the perspective of the investor. So the parent company is giving its own shares against the acquisition of subsidiary company shares. The cost of investment is going to be calculated at the fair value of the parent company's number of shares given. At times, the students confuse this point because subsidiary company's share price is also given in the question. Please be very careful. The cost of investment is the value paid by the parent company. So if the parent company is giving its shares, we need to calculate the fair value of the parent company shares at the date of acquisition. Then we have loan stock. For this also we calculate the fair value at the date of acquisition. For the contingent consideration, we calculate it at the fair value initially at the date of acquisition, and this is going to be given in your question. You're not supposed to calculate it, and later on you need to see whether that contingent consideration fair value is increasing or decreasing. So at the date of acquisition, the fair value is going to be given, we recognize it, and later on any increase or decrease in it impacts our statement of profit or loss, and in case of statement of financial position, the retained earnings. So out of all of these workings, the main working which may require some calculation part is basically at the date of acquisition deferred consideration, for which you have to calculate the present value. Your question will tell you the discount rate to be used or may provide you the discount factor also. And secondly, you need to do the calculation for share exchange. This is all with the cost of investment that may be there in your exam. Normally in the questions, a combination of two considerations comes up. So you need to identify the type of consideration and then recognize it as per the rules. Common ones which come up in your exam are the cash transferred at the date of acquisition, deferred consideration, and share for share exchange. So please practice these perfectly. Contingent consideration and loan stock also come up, so we can't ignore them as well. Now let's apply the learning that we have done to a question from the ACCA Study Hub. This one was talking about the acquisition of 80% of subsidiary company on 1st April 20x4. Now, date of acquisition is very important. So, on 1st April 20x4, we are going to calculate the goodwill. I'm only going to pick up the relevant parts which are related to the different types of consideration. Now, the question says that the consideration consisted of cash of 42.5 million. I'm reading the second line of the question. So cash of 42.5 million was paid on 1st April, which is date of acquisition, and a further cash payment of 21 million deferred until 1st April 20x5. Now we have cash consideration, we have deferred consideration, and the deferred consideration has been committed to be paid after 1 year. No accounting entries have been made. The cost of capital is 8% and the applicable discount rate is 0.926. Now let's see what the question is going to look like. Right now we are at 31st March 20x5. Now starting off with the working, the cash at the date of acquisition was $42,500 thousands combined. Deferred consideration was 21 million. We need to apply the discount factor on it, multiply it with the deferred consideration to get the consideration. Now these two combined, 61,946,000 comes out to be our cost of investment. This is going to be used for the calculation of goodwill. Now we said that this calculation is going to be done at the date of acquisition, which was 1st April 20x4. We have calculated the present value. Now, in this case, because we are talking about deferred consideration, the question says that no accounting entries have been made with respect to deferred cash payment. When any such working is given or any such point is mentioned in the question, it means that we need to pass the double entry of this item. The examiner has not said this for cash part, which means that cash consideration has already been recognized in the financial statements, whereas deferred consideration has not been recognized. So we need to pass the double entry. If it is still unpaid, so we are going to include it in the consolidated statement of financial position. At the date of acquisition, we are going to debit the investment by 19,446 and we are going to credit the liability, which is provision for deferred consideration, by 19,446. But the working does not end over here. Subsequently, we have to do its unwinding also. We calculated the present value at 8%, so unwinding is also going to be at 8%. We are going to recognize it at 1556, 8% applied on 19,446 and credit to liability of 1556. Now, these constitute the total liability of 21 million. What I was mentioning earlier, that after the unwinding, the liability is going to come back to the actual value from which we have calculated the present value. The expense is going to go in the consolidated statement of profit or loss, and as per the format of IFRS 18, it is going to be subtracted after the profit before financing and income taxes. Once this has been subtracted, then we reach the figure of profit before income taxes. Now, in the goodwill calculation, we've covered the fair value of consideration part. Another question that I have over here for you from the ACCA Study Hub, if I read the requirement, it says that what is the cost of investment to be included in Paradigm Statement of Financial Position as at 1st October 20x5. So this was a straightforward 2-mark question on cost of investment. In this, the date of acquisition is 1st October, 75% investment done. The question says it was done by means of a share exchange of 2 new shares in Paradigm for every 5 shares in Strata company. So for every 5 shares acquired, the parent company has given 2 shares. Remember what we discussed? The parent company's number of shares issued multiplied by the parent company per share price is going to now constitute our cost of investment. So if we see this, there is a share for share exchange. Let's see how many Strata shares were acquired. There were 20 million total shares. We can see it from the financial statements that are available. The extract, the percentage holding was 75%. This gives us the number of shares to be 15 million. Against every 5 shares, the Paradigm company has issued 2 shares. So 15 million divided by 5 into 2, this gives us 6 million shares were issued by the Paradigm company. The per share price of Paradigm company has been mentioned in the question. It says that the market value of Paradigm company's shares at 1st October was $2 each share. We multiplied that with 6 million and we get the consideration of 12 million. Then the next part says that in addition, Paradigm company issued to the shareholders of Strata company a $100 10% loan note for every 1,000 shares it acquired in Strata company. So we are going to calculate the issue of loan notes also. 15 million shares were acquired against every 1,000. So 15 million divided by 1,000. The parent company issued $100 loan notes, so multiplied by 100, this gives us the consideration of 1.5 million. Now, this is something very important. These two are the total considerations. We are going to add them, and based on that, the answer is going to be beta, which is 13.5 million. Now, if you are preparing a consolidated statement of financial position, the fair value of new shares has been acquired. The double entry that is going to be passed is debit investment, credit share capital and share premium account. You can see over here that the equity shares are of $1 each for both Paradigm company and Strata company. So if the question says that this transaction has not been accounted for, we pass the double entry debit investment, credit share capital by 6 million, which is the number of shares, multiplied by $1, which is the nominal value per share, and balance goes to the share premium account. If the examiner implies that this has already been accounted for, then we don't need to pass the double entry in share capital and share premium, and the investment figure we can pick up from the cost of investment in the parent company's individual financial statements. These are going to be then recognized in the consolidated statement of financial position. In terms of loan notes also, if they have not been recognized in the financial statements, we debit investment and credit the loan notes. These are then going to be listed as non-current liability in the consolidated statement of financial position, and interest expense is going to be calculated on them on a year-on-year basis. This expense is going to reduce the parent company's profits in the retained earnings. Now, these were the items that were included in the goodwill calculation. There are certain items which are not included in the goodwill calculation, and I wanted to highlight them as well. This includes expenses like legal fee, advisor fee, transaction fee. All of these are going to be charged as an expense in the statement of profit or loss. They do not become a part of your goodwill calculation. Now, coming to the next part in our goodwill calculation working, non-controlling interest. Non-controlling interest is calculated as a percentage of fair value of the identifiable net assets of the subsidiary company. There are two methods which are used for the calculation of NCI. This particular method is called proportionate share of net assets. So over here, we take up the subsidiary company's net assets and apply the percentage holding of NCI to it to get the NCI percentage to be shown in the goodwill working. If this is not the case and full goodwill method is being used, in that case, we calculate the fair value of NCI at the date of acquisition. Now, this is the working that we're talking about, non-controlling interest. And if we are talking about the fair value of identifiable net assets, then the working is straightforward. The value that we have used for the fair value of identifiable net assets of acquiring, we pick that up. Let's suppose NCI shareholding is 20%, we apply 20% on it, and that figure is shown as NCI. But this is not the case in fair value. If the fair value of NCI is to be used, which means that full goodwill method is being used in the question, then either the fair value of NCI will be straightforward given in your question, and if it is not available, then you can take up the number of shares attributable to NCI and multiply it with the subsidiary company's per share price. This will give you the fair value of NCI at the date of acquisition. This is why the question gives you the subsidiary company's per share price also. This amount related to NCI is going to go and be shown in the consolidated statement of financial position working also for the NCI. Now, let's apply this to the question, this paradigm question. This was an OT case question from the section B of your exam. So we have another requirement related to it, which is what is the amount of NCI as at 1st October 20x5. We are talking about the calculation of NCI. Now, in here, we have 20 million shares which were related to subsidiary company, 25% was the shareholding, and the yellow highlighted part that you can see, it talks about 1.2 per share was the share price of the strata company at the date of acquisition. We multiply all of this and we get the figure of 6 million. This is the fair value of NCI at the date of acquisition, and this is going to be the figure which will form the base of the calculation of value of NCI in the consolidated statement of financial position also. Now that we're done with the second part, let's come to the third part with respect to goodwill calculation format. That is the fair value of identifiable net assets of the acquiring company, which is the subsidiary company. Remember, we are talking about fair value. So we need to bring the assets to the value at which they are at the date of acquisition in terms of fair value. We take the net assets. Remember, the net assets of a subsidiary company, in general, also net assets are equal to equity of a company. So we are going to apply this rule for the subsidiary company also. Now, in case of fair value of identifiable net assets acquired, as the net assets are equal to the equity of a company, we are going to recognize it through this method, that we are going to calculate the equity of the subsidiary company at the date of acquisition. This is first of all going to have share capital in it. So we take the share capital of the subsidiary company 100%, retained earnings at the date of acquisition. This is something very important. Remember, we are doing goodwill calculation at the date of acquisition. So you need to calculate the retained earnings also till the date of acquisition. These are also called pre-acquisition retained earnings. Then we have certain fair value adjustments in it. There can be a positive balance also. There can be a negative balance also. Your questions may give you any other equity part or reserve also till the date of acquisition. So the value of whatever reserve is available in the question, that should be calculated at the date of acquisition. Now, when we talk about fair value adjustments, it's interesting that we are seeing a positive balance also and a negative balance as well. Now, the positive fair value adjustments can be because of a number of different reasons. If the fair value of an asset is higher than its carrying amount, then it is a positive fair value adjustment, which will increase the equity of a company. If fair value of a liability is less than its carrying amount, then also it is treated as a positive fair value adjustment in the goodwill calculation. At times, there are internally generated identifiable intangible assets also, which have not been recognized in the subsidiary company's financial statements. Now, this is interesting because the recognition of intangible assets is as per the criteria which has been set up in the IS 38. IS 38 says that any internally generated intangible assets cannot be recognized in the financial statements unless they meet a certain development criteria. So the subsidiary company may have certain assets which are not recognized in the subsidiary company's financial statements. However, when parent company goes to acquire the subsidiary company, IFRS 3 becomes applicable. And IFRS 3 says that the intangible asset is recognized if identifiable, and the word identifiable basically means that it is capable of separate sale separate from all the other assets of the business, or it arises by a legal or a contractual right. If that's the case, then we are going to pick up this figure and show it in the financial statements, which are consolidated financial statements. This adjustment will need to be done every year, and then the amortization or the impairment of this asset will also need to be done every year. A common example of such assets in our questions are customer lists, we have brands, order backlogs, etc. Now, the second part of fair value adjustment, which is related to a decrease in fair value adjustment, this can be due to the fact that the fair value of an asset is lower than its carrying amount, or the fair value of a liability is higher than its carrying amount. This can be in the case of deferred tax also. It was tested in one of the past exam papers. Another example is that a contingent liability hasn't been recognized because a present obligation isn't probable. Now, as per the rules of IAS 37, the fair value of a contingent liability is not recognized till the time there is a probability of it incurring. So the probable criteria, if it's not there for subsidiary, it won't recognize. But when the parent goes to acquire the subsidiary company, the contingent liability is going to be recognized in the financial statements. So this ultimately becomes a part of the working of the fair value of identifiable net assets acquired. In your questions with respect to consolidation, there is normally always a fair value adjustment, but please see very carefully whether it's going to impact the net assets positively or negatively, and is it a one-off item. So it's a one-off adjustment, like the fair value adjustment on land is just going to be one time, but if the fair value adjustment is on a depreciable asset, then in the subsequent working post acquisition, we need to do the impact or calculate the impact of the accumulated depreciation arising because of the fair value adjustment also. So any post acquisition adjustment also needs to be taken into account. Another question over here for your understanding. So it says that the fair value of net assets of Salva at the date of acquisition will equal to their carrying amounts with the exception of an item of plant which had a carrying amount of 12 million and a fair value of 17 million. The first thing which we need to see is whether we are dealing with an asset or a liability. We are talking about a plant over here, so it is something which is an asset. Its carrying value is lower, its fair value is higher, and then the question says that the plant had a remaining life of 5 years straight line depreciation at the date of acquisition of Salva. Now, over here, for the fair value adjustment with respect to plant, we need to add it in the working for the cost of investment, because this is a positive adjustment. The value of an asset is increasing. The second working is, in addition, Salva owns the registration of a popular internet domain name. The registration, which had a negligible cost, has a 5-year remaining life. At the date of acquisition, however, it is renewable indefinitely at a nominal cost. And the domain name was worth 20 million. Now, over here, at the date of acquisition, this is also an asset which is not recognized in the subsidiary company's financial statements. So we are going to recognize it at 20,000, and that's going to be added to the working of fair value of net assets. The question then tells us also about the remaining useful life. Because of that, we are going to charge additional depreciation also. So we first of all add 5 million to the property, plant and equipment. The working that we saw with respect to net assets, that is credit side of the working. The debit entry is going to go to the property, plant and equipment. Later on, we are going to deduct accumulated depreciation of 5 million from the property, plant and equipment over the 5 years life that has been mentioned. The group percentage of additional depreciation is also going to be deducted from the retained earnings, and we are going to deduct it from the calculation of NCI also. With respect to the domain name, also they have provided us with the remaining life, and the question says that it is renewable indefinitely at a nominal cost. So we are going to add 20 million to the intangible assets, and we are not going to have an impact with respect to the impairment or the amortization. In such cases, when we have an indefinite useful life with respect to an asset, we are going to test it for impairment annually. Now, seeing the overall calculation together, so we have the fair value of consideration, we take that, then we have the value of NCI, we take it in the outer column, then we calculate the fair value of net assets, which was there. So share capital, retained earnings, we have fair value of property, and if there was a contingent liability, then that is going to be subtracted, because if the liabilities increase, the net assets decrease. And the difference between these two is going to be goodwill or a bargain purchase gain. Goodwill is shown as an asset in the consolidated statement of financial position, and bargain purchase gain is an income which is added to the retained earnings. So these marks, these are easy marks of your question. Picking up each figure may get you 0.5 to 1 mark. So please be very careful about these workings, as these are some things which come up very frequently. These should be on your tip so that you should very comfortably solve whatever question comes up in your exam. The final figure is going to be shown in the financial statement. So if it is a positive balance, it is a non-current asset. We do not amortize goodwill. Rather, it is tested for impairment annually because it also has an indefinite useful life. And in case of a negative goodwill or a bargain purchase gain, we credit it to statement of profit or loss immediately, and it is allocated to the owners of the parent only, because this is a gain that the parent company has secured at the date of acquisition. So they bought something which was of a higher value at a lower price. So it is going to be added in the retained earnings and shown as an income in the statement of profit or loss. Lastly, towards the second part of the goodwill calculation, which is post-acquisition, we need to test it for impairment annually. In case there is impairment, we deduct it on one side from the carrying value of goodwill in the consolidated statement of financial position. The second part, where we charge the expense to either the group or the NCI, it depends upon how we measured NCI at the date of acquisition. If NCI was measured as a percentage of net assets, or what we call proportionate share, then we deduct the impairment only from the retained earnings in the consolidated statement of financial position. However, if NCI was measured at fair value, then we deduct the percentage related to the parent company from the retained earnings, and share of NCI in the impairment is deducted from the NCI working in the consolidated statement of financial position. So please be very careful that what method is being used in the exam. In case of proportionate shares, the full amount is charged to the group retained earnings. Here is a simple example of NCI as a percentage of net assets. So if we have a consideration of 1000, the fair value of net assets was 800 and NCI was at 10%. So we take the 10% that comes up as 80 and we calculate the goodwill. The impairment is going to be charged at 20% and the balancing figure is going to go in the consolidated statement of financial position. Now let's see, how is it going to be distributed between the group and the NCI? If we are talking about proportionate share method, then the whole amount is going to be charged to the group. You can see over here, impairment is only charged to the group retained earnings and nothing is charged to NCI. So we deduct it from the group retained earnings. In the consolidated statement of profit or loss, the latest format as per IFRS 18, we are going to show the gross profit. In that, other operating income is added. Then in the tab where we are deducting the operating expenses, goodwill is going to be subtracted, and after that the profit that we get is called operating profit. This is the representation of goodwill impairment in the consolidated statement of profit or loss. Another short example with respect to NCI at fair value is that we calculate the consideration. We have the fair value of NCI, which was 100. Now, when in this case we show it in the group and NCI, we are going to distribute it. So here you can see that in the previous example that we saw, the complete impairment of 56 was charged to the group. We have charged 50 to the group, which is 90% of the impairment, and 10% has been charged to NCI. This is how it is going to be shown in the consolidated statements, deducted from group and deducted from NCI. So this is all with the working of goodwill. We have covered the calculation of goodwill at acquisition, how we are going to talk about bargain purchase gain and account for it, and the knock-on adjustments which are there in preparing the consolidated statement of profit or loss and consolidated statement of financial position. Please do a lot of practice of all of these steps that we have done There are multiple questions in the study hub as well as the practice platform by ACCA with respect to consolidation, and almost every question has a calculation of goodwill in it. So please practice, practice, practice so that when you go in the exam, these are the easiest marks for you. Thank you so much. I hope you found the video useful and will gain benefit from it. Best of luck for your exam.